Hi, thank you for tuning in. Welcome to the It's Your Money and It's Your Estate workshop series brought to you by our nonprofit organization, Financial and Estate Literacy. Our mission is to empower people like you to take control of their finances, their estate, and charitable giving decisions. For the past 25 years, our founder, Peter Kote, and our entire team have been providing these free, unbiased, and accessible 6 weeks programs all over Orange County, California to help you make informed choices that align with your unique needs and values. Now let's start the program. This webinar is the fourth session of the It's Your Money program. The topic is Investment World. Our guest speaker is Paul Horn, our moderator, Peter Kote, and this webinar is brought to you by Chapman University. Enjoy the workshop.
Welcome to the It's Your Money program. We're in week 4, I believe. Yes. And we're going to talk a little bit about the investment world today. But before we do that, let's do a little introduction of Paul. Paul, what kind of educational background do you have?
Yeah, so I've been in the industry for about 20 years now. I hold a master's degree in investment management. I am a CFP, certified financial planner, and a CPWA, certified private wealth advisor.
How many years have you been into business?
About 20 years.
And you used to be on the dark side, and I love the story that you usually tell because that's
Yeah.
kind of what we're going to talk about today. That the financial world has a lot of highly integrity individuals in it, but the field is sales. And if you're not a good salesperson, you're not a good broker. And talk a little bit about your experience on the sales side.
Yeah, so I actually started in the bank channels myself. I worked for Wells Fargo, USAA, JP Morgan private client. And that's really where I cut my teeth. And in that side of the world, you're pretty much as good as your last sale. For me, what kind of was the straw that broke the camel's back, so to speak, was at JP Morgan. I was on a sales call. I was doing really well on the sales front, but I wasn't selling annuities. Annuities typically are best for the person selling them or best for the company, not best for the client. And I got called out in front of my peers for having zero annuity sales. And even though I was a great performer, getting called out for zero annuity sales was kind of the last straw where I realized, I'm trying to do what's best for the clients. They're trying to, JP Morgan is trying to do what's best for JP Morgan. And it just didn't align with what I was trying to do.
Yeah. So today you're with a fee only fiduciary registered investment firm. Is that correct?
Correct. Correct. Yeah. So today I'm with a company called Benefit Financial Services Group. We go by BFSG for short because the other's kind of a mouthful. Here at BFSG, we are a fiduciary, so we have chosen to do what's in our client's best interests at all times. That is the standard that we've chosen to hold ourselves to. We are fee only, so the fees that our clients pay us is the only money that we make. And this is
You
really
don't
important. Sorry, go ahead.
you don't get money from any other source?
We don't, no. So like
Okay.
if a client needs life insurance, I sold it for 15 years. So if I tell you you need life insurance, you probably need it, but I'm not making any money on that recommendation. I can refer you to individuals that sell it, and they'll make a commission on the sale. I don't see a dime or penny from that. That's
Yeah.
just value add or trying to do what's best for our clients.
And you assist them in getting that insurance.
Correct.
So
Correct.
that they're paying not overpaying or being overinsured.
Correct, which is different than when I was at the JP Morgan or Wells Fargo. That was what's called the broker dealer model, which is on the right here. And this one is more of a transactional relationship where most of the money the brokers are making are through commissions. So if a person in this channel tells you need insurance, it gets kind of confusing because there's an inherent conflict of interest where the broker is going to make a lot of money selling you the policy. So you're not sure if they're telling you need the policy because you need it or because they're trying to make more money.
Yeah. And everybody has to be registered under FINRA. Do you have any security licenses at the present time?
So I do. I have my Series 7. I dropped my Series 7. I have my Series 66, which
And
covers states. Yeah.
yeah, and Series 66 is not really a license to sell. It's a registration that you're given investment advice.
Correct. It allows us to manage the investments for our clients.
Yeah, and Series 7 is what allows you to sell securities.
Commission-based products. Yeah.
Yeah, and so you do not have a Series 7
I do not.
license, which is a good thing. So by law, you can't
Yes.
even if you wanted to sell somebody a security, you wouldn't be able to do it today.
Nope. We just manage money. Keep it simple.
Okay. How do you charge your clients?
So 99% of our clients are paying us a fee. That fee is based on the size of the relationship or what's called assets under management. So our fee is 1% all in. We like to keep things very simple. We think life is complex enough. So the 1% includes all financial planning, includes the management of the investments. And so if we're managing 100,000, that would be an annual fee of $1,000, for example.
And we went through financial planning in the second session. So you would go through a comprehensive financial plan, and that would be included in the fee for assets under management.
Correct, correct. Yeah, I'm actually the director of financial planning, so I lead that team here at
Okay.
BFSG.
And do you have a minimum as far as clientele is concerned?
We don't. I have clients that have like 5,000 with us. I have other clients that have over 55 million with us.
Okay.
So our belief is we just want to meet our client where they're at and help them reach the next stage in their life.
Okay. And do you offer any kind of a free consultation that would you review someone's financial plan or their investments today at no charge?
Always. Yeah. So we're happy to always do a complimentary review. One, we just got to make sure that what you want aligns with what we're doing. If it doesn't, we're going to let you know that we may not be the best fit for you.
Okay. I recommend highly that if you're seeking out a financial advisor, that you seek out a fee only, that you seek out a person who's a fiduciary. And then the last thing is that they meet at least with 3 different financial advisors because the rapport needs to be there. You know, that it's like a marriage. If you're going to go with Paul, you're going to be with him for the next 25 years or 20 years. You know, you don't want to skip and jump around. So you want to do a little bit of work on the front end. And
Absolutely. It's like any other relationship in life.
yeah, yeah, you want to kiss a few frogs, but not your entire life. All
Yeah.
right. Let's see.
All right.
Let's get right into it. Get the program.
Yeah.
How do you find somebody like you? Because you're a rare duck. 95% of individuals who are in the community here in Orange County are brokers. They're not what I consider to be financial advisors.
Yeah, the first thing that I would be looking for, we've already talked about, but we want to find someone that works for what's called an RIA, Registered Investment Advisor. That means that they're acting in a fiduciary capacity. It gets a little confusing because there are some that are fee only and there are some that are fee based. And the ones that are fee based are kind of a hybrid where they still can act like a broker and make commissions. If it's fee only, they're not going to make any money other than the fees that you're paying them. So there's no sales commissions, there's no referral fees, nothing like that. The other thing that we want to look for is designations. There's a lot of advisors with alphabet soup behind their names. Most of those designations are actually done by for-profit colleges. So it's just kind of a scheme for a get an easy designation so you look like you know what you're doing and the college makes money off of it. The three that I would focus on would be the CFP, Certified Financial Planner. They specialize in financial planning specifically. So topics like taxes, estate planning, investments. That one is about an inch deep, but a mile wide in terms of the knowledge base that they have to have. Otherwise, if you're looking for a lot of help in taxes, having an advisor that has a CPA is going to be best if you're looking for help on the tax advice side. And the final designation is the CFA or Chartered Financial Analyst. And this is someone that specializes in investments. This one is a foot wide, but a mile deep. So that one is very specific to someone that just manages investments. They may not have the expertise when it comes to financial planning items.
Yeah, there's probably over 120 different designations in the financial services industry. And people don't know the difference between what a good designation is that you actually have to earn versus one that you buy. And people tend to believe people who have designations behind their name, whether they know what it means or not. So
Yeah,
Google those designations so you get an idea as to whether or not it has any meaning. But these are the three that are the main ones.
the big thing here is there is a certain level of integrity and standards that are held to all advisors are held to when they have these designations. So in fact, some broker dealers like Nationwide won't even let their advisors have the CFP because their sales culture doesn't align with what the CFP teaches.
Yeah. And it makes them more liable,
Yep.
higher standard. Custodian. Who do you custody your money through, Paul?
Yeah, so we hold our money at the big two. We use either Schwab or Fidelity, depending on our clients' needs.
And what does
Um,
that mean, custody?
Custody means the money's being held somewhere else. So if my company went bankrupt tomorrow, your money would be safe because it's not with us. It's being held at Fidelity or Schwab. Those are companies that are the largest custodians in the country. The government views them as too big to fail. So your money is safe. It helps avoid those Bernie Madoff situations. You don't want your advisor having access to the money. So if it's at Schwab or Fidelity, your advisor only has permission to make changes to the investments on your behalf.
Yeah, and they're to send you money, to send the
Yeah,
client money, and also to get paid. So there's
yeah.
usually
Our fees are taken out of that. Correct.
yeah.
Correct.
So, but in fact, how do we fire you, Paul? Let's say, we thought you were a nice guy, but you went downhill after our first meeting.
Yeah, if someone doesn't see us as a good fit, and that happens from time to time, all we ask for is a 30-day notice. But honestly, you don't have to do anything. You can notify Schwab, and next day we're taken off the account.
Yeah,
Because
you can
again, you're just giving us permission to manage the investments.
yeah, it would be nice if you let them know, but there's no obligation to do so. And all you have to do is tell Schwab or Fidelity, I don't want my advisor any longer.
Yeah, simple as that.
Yeah. Confirm that they can meet your individual needs. What do you mean by that?
So this just goes back to what you said, Peter, about this is a relationship like anything else in life. You want to find someone that you trust, their philosophy aligns with yours, and you want to find someone that works with clients like yourself. If you're a dentist and you have a dental practice, it would be good to find an advisor that has experience working with other dental business owners or other dentists. So asking clients like that or finding advisors like that can be really helpful. Every advisor works with retirees. If that's your case, almost any advisor is going to work. But if you do have a kind of a unique situation or specific kind of niche you're in or looking for, there are advisors that fill just about every niche these days.
Yeah. Do you charge clients more if they want to meet with you on a monthly basis?
No, so our fee, like I said, is all encompassing. We have some clients that want to meet with us once a year. I have other clients that want to meet once a month.
Yeah.
So
So
it's everybody's
distance
comfort
is
level.
distance is important, Well, where are you
Sure.
located?
So we have our main corporate headquarters is in Irvine. We're right next to John Wayne Airport. We do have a second office in Phoenix as well.
Uh-huh. Do you ever go out and meet with clients in their homes?
All the time. And all the
All the
time. So in
time.
fact, yeah, my partner is actually doing that today, meeting with a new prospect in their home.
Okay. So How often do you meet? Where do you meet? Those are important questions to ask. Uh, how do you make your investment decisions?
So for us, it's a team-based approach. We use a mixture of what's called quantitative and qualitative data. So we have a computer look at everything and kind of based on parameters that we've set, kind of give us an idea, a short list of the best investments out there. And then we go out and we'll research those investments on ourselves. We have a team of about 15 individuals that does that to get it down to the best of the best and from our viewpoint.
So do you primarily use mutual funds, ETFs, or do you primarily use individual stocks, or do you use a combination of the above?
We use a combination. We use what's called a core satellite approach. So the core or the bulk of someone's portfolio is going to be in a balanced approach of ETFs and mutual funds. And depending on the account size, typically around $1 million or more on the accounts, we may start adding individual stocks or individual bonds on top of that.
Okay. And the reason for that is where you have the $1 million threshold is why?
Proper asset allocation. We want to
And
make sure that the money is
diversification.
properly
Yeah.
diversified.
Yeah. By the way, we're going to learn a little bit. There's over 30,000 mutual funds out there. And we'll talk a little bit about the mutual funds that you pick out, Paul. Are they like the 30,000, or what's special about the mutual funds that you pick out?
So where it gets confusing is you can have one mutual fund like T. Rowe Price Large Cap Growth. It's a great mutual fund, but there's what are called 8 different share classes on that one mutual fund. So you can have 8 different fee structures on that fund. The advantage that we have, given our size and our scope, is we're able to get the cheapest fund for our clients. So if a retail investor goes to buy the fund, they're going to be paying a higher price for that mutual fund than what we can get it for.
Yeah. So your average broker charges are between 2 to 3% per year, but it's very difficult to find that fee. Whereas in Paul's case, you're going to pay a 1%, but all of your mutual funds and all your investments are going to be no commission and at low expense.
Yeah,
So
and we'll cover that later on a slide for sure.
yeah, but I just want to make sure that that's one of the services that you offer.
Yep, absolutely. And
Okay,
then the last thing,
yeah, go
uh,
ahead. Well,
okay, yeah, just the last thing here is when you're looking at advisors, you want to be able to look under the hood. They may sound great, they may look great, they may on paper check all the boxes. You really need to kind of check under the hood, so to speak, kind of like buying a used car. It's good to bring a mechanic to kind of tell you what's going on mechanically with the car. With an advisor, there's what's called the Form ADV, that every firm has to create each year. That's going to give you all the details on the firm. It's going to help you understand, are they selling insurance? Are they charging you extra fees? So some firm, for example, may charge you a fee for investment management, and they may charge you another fee for financial planning. You can get all that kind of information in the ADV. The other thing that you want to use is what's called broker check. This is done with FINRA, and this allows you to see if the advisor has ever given any bad advice in the past. So if we look here, for example, I've gone to broker check at FINRA here. I just typed in a random name, Scott Mason. I don't actually know the advisor, but I just wanted to kind of highlight here. You can see there's actually 312 people with that name. Pretty crazy. But what you can see here right away is, let's say you're looking up this advisor, you can see he's barred. That means that he's no longer allowed to sell in the industry because he broke the rules. Now, what we want to find, more likely, if you see this, they're probably not selling you. They're probably out of the industry to begin with. But what's interesting is, let's say you're working with this industry individual here, 23 years of experience. That's great. But you see disclosures here. Yes. That means that something has occurred over their career where they were found to have done something wrong. In this case here, it talks about what the client had done. Some sketchy sales practices for 5,000 on mutual funds. So they were fined for that and held accountable for that. But it allows you to see that kind of information. The ideal ones you're looking for are something like here, this Ryan Scott Mason, 20 years experience, no disclosures.
Yeah.
That means over their 20-year career, they haven't been found guilty of doing something they shouldn't have been doing.
Yeah. By the way, and it's not easy to get into disclosure. I mean, usually you have to hire an attorney. Most individuals that something wrong happens, they do not complain because they feel nobody held a gun to my head. So when you see a disclosure, it's real. And we check the ADV forms and we check FINRA for any presenter that comes on our program because you got to check, as Paul said, under the hood. And FINRA is a great way to do it. It
Yes.
uh, you show up on FINRA as well. Can you bring up your own name just for the heck of it?
Yeah, of course. So I'm here. I'm located out of our Phoenix office myself. Um, and here's where it gets a little confusing. So here, as I said earlier, I have about 20 years experience. Here it's only showing 12. And the reason for that is the licenses that I have to carry. But you can see here, I've been with BFSG since 2019, but I don't have to carry the same investment licenses that I had to carry at these other ones with the Series 7 and all that. So this is a good way to find, but advisors that are like myself that work in RIA, all
So
their
we
information may not be shown.
click on the investment advisor.
Sorry, where?
Yeah, go to the SEC website. See where it says on the right. Yeah.
Yep.
Boom. This is where you
Now
know you're dealing with a fee-only advisor.
you got it. And then, oh, there's my information right there.
Yeah.
So 17 years of experience, 11 firms.
Yeah. Anyway, please
Yep.
use broker check. There was a fellow in Laguna Beach that had disclosures on FINRA, and he just got indicted for $20 million of fraud because he was such a nice person. People put him in as a fiduciary in their estate plans. So, but he had disclosures back to 2022. Simple lookup, you would have never included him in your estate plans.
Yeah. And so when it comes to all these disclosures and stuff, you want to know who's overseeing us advisors. The most basic one is FINRA, which we've already mentioned. They're the ones that run broker check. They're a self-regulatory organization. So brokers, the firms that are out there, the JP Morgans, the Wells Fargos of the world, the Merrill Lynches, they've agreed to self-regulate themselves, and that's where FINRA comes over. Now the ultimate say or the ultimate authority is going to be the SEC, the Security and Exchange Commission. This is the government entity that oversees the entire industry and oversees Wall Street.
But it's a little bit like the fox watching the hen house.
Yep. Okay, so we've talked briefly on this. The one that you want to be looking for is the 65 or the 66. The 66 is the combination of the 63 and 65. If they have the 7, that just means that they're going to sell you, that they have the ability to sell you commission-based products. The 24 and 53 are just for supervisors or managers.
It's a weird way because the supervision responsibility is to say you got to go out and sell, but you got to sell ethically. But if you go out of bounds, well, it's okay, but we're not gonna try to stop you either because we're benefiting from it. It's a real it's a crazy system.
Well, it is, and it all comes down to what's called the fiduciary standard or best interest standard.
Yeah.
RIAs are fiduciary standard, have to do what's in the client's best interest at all times by law.
Yeah.
Most of these broker dealers, they're just operating on best interest. So as long as it makes sense, it doesn't have to be what's best for the client, but it has to be a good recommendation.
It's a
So
sales world. Okay. That's what
it
we're
is.
trying to get across. Let's go to the next slide.
Okay. Move to life
Let's talk
insurance
about
here.
one of the first products that is sold. And this product, insurance, has the highest commissions.
It does have some of the highest for sure. So when it comes to life insurance, there's two types. There's term and perm or permanent. Term is your traditional insurance, lasts for 10, 15, and 20 years. Typically, you pay the same rate each year over that 10 to 20 year period, typically. Sorry, I have the hiccups here. And just no cash value. It works like auto insurance where God forbid something happens and you need it, it's there. Hopefully you don't and you never use it. It
So
is the
for
cheapest.
90% of the people, they should be looking at term.
Correct. Yeah, there's an old phrase in the industry, buy term and invest the difference. Uh, Term's going to be the most cost-effective way to go. And for most, I'd say 95% of all clients, that's all they're ever going to need is term.
Yeah.
That should be the starting discussion, unless there's a unique situation where you do need insurance for the rest of your life. Maybe there's a special needs child that you're trying to make sure money's left behind for, to make sure they're taken care of over their lifetime. If you have a situation like that, a permanent life insurance policy is a great way to go. If you're trying to cover estate taxes or charitable gifting strategies, permanent insurance can make a lot of sense in those sort of worlds, or if you're trying to accomplish those goals. Now, here with the permanent policies, they are designed to last the rest of your life, and they do maintain a cash value. So if you cancel the policy, you'll actually get back what's in the cash value account. Now, a lot of advisors will sell the cash value as a way to invest or help fund future retirement goals. The problem, though, is this cash value, all it is you front loading future premiums to lower the cost of the insurance over time, right? So if we have life insurance, the cost looks like this. The older you get, the more expensive the insurance becomes. So on the permanent policies, they try and make the premiums level or as close to level as possible. And so in the early years, you're paying in more than you need to. And then that money's growing, whether it's invested in mutual funds or interest or whatever the case is, but that money's growing over time. And that money growing over time is used to offset those future premium increases. So if you use that cash value, you're going to lose the policy itself.
Here's annuities. Forbes magazine called, besides fixed annuities, and this was 20 years ago, variable annuities, legally stealing. And, annuities gotten a bad name. And one of the reasons is that we're going to talk about just a little bit, but fixed annuities might be in the exception. So talk a little bit about what is an annuity?
Yeah, so life insurance is betting against you're going to live too short. Annuities are betting against that you're going to live too long. An annuity is designed in its original form to be a paycheck for the rest of your life. The original annuity was a basic concept. You give a lump sum of money, and then that lump sum of money in turn gets turned into an income stream plus interest over the rest of your life or over a specified period of time. So that's what annuities are designed to be. Okay. However, they've turned into a great sales product for advisors to sell, high commissions. And so they've gone kind of fancy. The fixed annuities, these receive a guaranteed rate of return. So you put your money in and it works just like a CD. You know to the penny how much money you're going to make with a fixed annuity. Typically with these annuities, the rate is fixed for 3, 5, or 7 years, and then it adjusts based on interest rates at that time. Now, variable annuities are an older form of annuity. These have been around several decades. These, the money's put into the annuity, and then the money's invested in underlying mutual funds. And so your rate of return is dependent on the rates of return in the stock market or the bond market, or however the money is invested. So with a fixed annuity, you have no investment risk. With a variable annuity, potential for higher returns, but you're taking the investment risk at that point. An indexed annuity is where the returns are linked to the S&P 500. And these are supposed to be the best of both worlds, where these ones, if the market goes negative, so like the S&P in 22 was down 18%, your return that year would have just been zero. You wouldn't have lost money, you just wouldn't have made money.
Yeah.
So index
Most
annuities are popular because they sound really good, but we're going to look under the hood here and show you some of the concerns if you're thinking about using an indexed annuity.
And these are the ones that are being sold today at most of your free dinner seminars or workshops or educational programs. They're going to focus in on the indexed annuities. And
It's an
we'll
easy,
find out in a little bit why.
yeah, it's an easy sales pitch. Oh, you're linked to the S&P 500. It's the best performing stocks index out there. So you get all the upside and you get none of the downside if they have a down year. That's the sales pitch. Sounds great, but if it's too good to be true, probably is.
Probably is.
So with annuities, there is what's called a surrender period. So with an annuity, your money's locked up for a period of time. They are illiquid. So if you put your money into an annuity, that surrender period typically is around 7 years. I've seen it as long as 15 years. And that means if you take your money out before that surrender period is up, you actually lose a portion of the money. So, for example, this is a real annuity that one of my clients had a 7 year surrender. So, if they had this annuity for 1 year and after 1 year said, you know what, I don't like it, I want to get out of it, they say, great, you can do that, but we're keeping 100, your balance is 100,000, we're keeping 8%, which is going to cost you 8 grand to break the annuity. So you're only getting 92,000 back in that example. You can see over time, they typically, the closer you get to the end of the period, the lower the fee becomes.
And the reason for that is that usually the person who sold you the annuity, that's kind of approximately what they receive after you have that annuity for 30 days. On all insurance products, you can rescind that contract within 30 days of signing. And the
Correct.
reason for the 30 days, because nobody understands them. They're very difficult to read and figure out. So the law says everybody has 30 days once they sign to get out of that contract if they feel like they need to.
Yeah, and if you do have an annuity that's in a surrender penalty, a lot of times there is a small loophole that you can take advantage of where they will allow you to take out about 10% of the value each year. So it is a way to slowly drip some money out if you want to, while it's still in the surrender phase.
Yeah. But if you have an older annuity, it may, like, especially on the fixed side, it may behoove you to keep that annuity because might be paying a good income to you. So don't, just because you have an annuity doesn't mean you're going to get rid of it. Have somebody take a look at it.
Correct. Now, when we look at fees, for a fixed annuity, there is no fee. The fee's baked into the interest rate that they're paying you. So it's very simple, very straightforward. You just get your interest, you collect your interest, and it's done. With the variable annuity, as we mentioned earlier, these are invested in mutual funds. So with these ones, they're a little bit more complex in their fee structure. So for a variable annuity, you're always going to have what's called M&E, or more commonly mortality and expense. This is the actual cost for the insurance for the annuity itself. This is typically around 1 to 1.25%. Oftentimes there's an administration fee for another 0.25%. This is the cost of creating the statements and mailing them out to you and all that sort of stuff. Then aside from that, you're going to probably have mutual funds investments. Those typically cost around 1% per year to have that access to that investment. And then oftentimes on top of that, because annuities are designed to provide income streams, oftentimes you'll get some sort of guarantee, which is called a living benefit rider. Think of it kind of like a toll road. You're paying extra money to get extra benefits. That's the idea of it, but that fee could be 1%. So very easily, most variable annuities carry a fee on average of 2.5 to 3.5% per year. So if your money's invested in the market, it does 5%, where you're going to lose about 2.5 to 3.5% per year just to cover the cost of the policy itself.
Yeah. And all the income that you get from a variable annuity is going to be ordinary income, not capital gains.
Correct.
Yeah. Let's go to the one that gets sold everywhere.
All right. So this is an index annuity. Again, this is a real life client example. We did not sell this. The client came to me in 2020. This was their return at the end of the year. So with an index annuity, you don't pay any fees up front like a variable annuity. Okay. What happens is you're going to be linked to some sort of index, and that index is either going to have what's called a cap rate, or it's going to have what's called the participation rate. So for example, the most common index is S&P 500. If you see on this example here, there's a monthly cap of 1%. So that means if the S&P goes up 3% in 1 month, that individual's capped at receiving 1%. So you see the first month of the year on this policy, the markets are up 3.28, but they are capped at 1%. What they don't tell you is you're not capped on the downside. So if you look here, this year, the S&P was up 15.76%. This was the total return on the S&P 500. But based on how they do the math for these indexes, you're capped at 1% per month, right? But on the downside, you're not capped. You're uncapped. So markets are down 1.3%. Their return is negative 1.3%. You remember when those lockdowns got announced, the markets dropped very aggressively, very quickly. We see that these 2 months. For those 2 months add up to negative 20% for the year. So their total return at the end of the year, based on how the math is done for the index, negative 16%. The client's, what should have been their real return was positive 15%. So the insurance company keeps this 15% positive. They pay you nothing in one of the best years in the last 10 years in the stock market.
Yeah. And by the way, and you got to do this kind of math, and this math is hidden, well, not hidden, but in one of 25 pages in your indexed annuity contract. And, they're awful. So please stay away from indexed annuities. They sound really good, but you've got to look under the hood, and it's not
Not
easy.
not every product is this bad. This is
No,
obviously an
this is
extreme
worse.
example,
Many,
but
many of the brokerage firms don't even sell this product because of these fees. Yeah, it's stay away.
all right, so let's transition here to mutual funds. These are the most common investments. So if you're looking to invest in stocks or bonds, most commonly that's done in a mutual fund. And with the mutual fund, all it is your money is pooled together with other investors. So let's say you want access to the S&P 500. Instead of having to go out and buy 500 stocks, you can take your money, pool it with other investors with the same goal. And then there's a fund manager that will go out and buy the 500 stocks for you in the mutual fund. And then what happens is you're going to get the return. So like I showed you that last slide, if it's up 15%, you're going to get 15% minus the fee, which is on average around 0.5% to 1%. And that fee is what goes to the mutual fund company for running the mutual fund, but you're going to get everything else. And you may have heard ETFs. They work very similar to mutual funds in structure, just some slight nuances and differences. But that's for another discussion for another day. But just know ETFs and mutual funds kind of work the same way here. With a mutual fund, there's one of 4 different fee structures. The one that we see most commonly are called Class A or Class C shares. Class A shares are a commission-based product. So if someone has a Series 7 or a Series 6 is going to sell you this. And this is where there's an upfront sales charge, typically around 5.75%. So if you invest 100,000 in this example, 5,750 is going to go directly to the broker. So day one, when you invest, you're not investing 100,000. You're instead investing 94,250. So you're behind the eight ball day one, trying to just make your money back.
So look at your statement, quarterly statement or monthly statement that you receive from your broker. You'll see if you have a mutual fund, you'll see after the name of the mutual fund, you'll see a class A, class B, class C. They have probably some mutual funds have up to F and G and different.
RZ. Yeah.
Yeah. And you don't know what that really means until you read the prospectus or go online and Google it and find out. But more load mutual funds in the marketplace than there are no loads, and more people buy load mutual funds than no loads. So if
Yes.
you know, this is a highly commissioned product, and
So yeah, I mean, the
beware.
reality, a lot of people are catching on to type class A's, so they're not as common as they were 5 or 10 years ago. A lot of people just don't want to pay that upfront sales charge of 5.75, and advisors have figured this out. So instead of selling A shares, what is more common these days are what are called C shares. Now, here you don't have an upfront sales charge, but instead you have a higher back end charge. So if you invest 100,000 day one, all 100,000 goes into the market. But like I said before, that annual fee for a mutual fund, which is called the expense ratio, which is the cost of running the mutual fund, on average, that's around 0.5%. Class C shares are typically around 2%.
Yeah.
So where it should be costing you maybe $500 a year on 100,000, instead it's costing you 2,000.
Yeah.
So
And
this is how
so
they get you.
yeah, so the broker will say we have fee based. I'm fee based. And they will put you in a class C mutual fund because they can say to you, well, I'm not making any commission on this, but you're paying a higher fee. So, it's confusing, but what you want to do is go no load. And what does that mean?
Correct. No load means there's no commission. These are done straight. There's no broker in between. This is done strictly directly with the mutual fund company. Most commonly, you're going to find this with like Vanguard, Fidelity, Schwab. If you go directly to them, buy their mutual funds directly from them, they're typically not going to charge you a commission because they're making money on that annual expense ratio of around 0.5% to run the investment.
Yeah. Vanguard does not sell any mutual fund with a commission on it.
Correct. All right. And then finally, we have Bitcoin. Cryptocurrencies have been all the rage up and down. The argument for them is they're a store of value, similar to what gold is. Gold's viewed as a store of value. The problem is Bitcoin has been far more volatile. We can see price swings of up 50% or down 50% very quickly. And it's hard to call something a store of value when it's extremely erratic in its behavior. Um, they're not they're not based on fiat currency, so it gets very hard to price some of the cryptocurrencies out there. Um, the only kind of interesting argument is maybe a medium of exchange, where it's a platform to allow Bitcoin to be used for payment. This makes it more attractive than some of the other options. Like you can't really use gold to go buy stuff, but you can use Bitcoin. So this is where it kind of gets interesting. But we don't sell cryptocurrencies for any of our clients. We don't have our clients invest in cryptocurrencies at this point because it's still the wild, wild west. There's a lot of there's very little legislation over them or regulation over them. And there is a lot of criminal activity that is being funded by cryptocurrencies.
And I find people who own or like Bitcoins or cryptocurrency are almost religious in their belief that this is the investment of the future. And be careful. should people own gold? I mean, we talked a
So
little bit about Bitcoin, but what about
yeah,
gold?
gold is interesting in its own right. How we view any of these investments, we have held gold for our clients from time to time as a hedge against inflation. Um, but
Gold
if you're
mines
looking
or gold
when we're
itself?
doing this, we're doing gold stocks. So there's stocks that you can buy or ETFs you can buy that mimic the price of gold, or have gold and they store it, and you're paying and owning a portion of that gold that they're storing. Those tend to be easier ways to invest in gold because you're not having to buy it itself. There's no middleman, there's no markups. It's
What
much
percentage of
easier
a
to get in or
person's
out.
portfolio? What percentage of a person's portfolio? First of all, do you have any gold today in your client's
We do
portfolio?
not.
You do not.
So,
Two is
well,
that if you were to have gold in a portfolio, give us a
w-
percentage.
1 to 3% typically. So again, we use a core satellite approach. 80 to 90% of our clients' investments are very traditional, following what we know works. And then we may have 5 to 10%, maybe 15%, depending on how aggressive the client's investments are in what we call high conviction ideas. That could include Bitcoin if that's something you want to do. But again, any of these speculative investments like gold, Bitcoin, other alternative investments really shouldn't be more than about 3 to maybe 5% of your total portfolio.
Commodities, are those high commission products?
They are, and they're very low regulatory on them. So a lot of interesting cats in that.
Speculation?
Yeah,
Yeah,
a lot of interesting people in that environment.
yeah, yeah. When sometimes when people talk about the stock market, they talk about they use it for gambling. There's a little bit of truth in that, isn't that?
Well, it's hard to call it gambling when all the greatest wealth this earth has ever seen has been created through the stock market. So I'm a little reluctant to call it gambling. Now, there's ways of going about it, like stock options or other speculative investments that absolutely would be akin to gambling.
Yeah. Yeah, day traders, market timers, uh, you, the
There's no such thing as market timing. That's catching lightning in a bottle.
yeah,
You don't have to be
yeah,
right once, you have to be right twice. When to get out and when to get back in.
yeah. But it's the encouragement of trading that's constant in CNBC. Gold is up this year, or fear factor. Uh, the more you trade, it seems the more commissions or the more profitable it
So,
is for Wall Street.
yeah, well, let me put on my financial planning hat real quick. I had a client came to me doing options. Options are short-term contracts. You're betting on which way the stock's going to go, whether it's up or down. That's it. Highly speculative. They did a great job, made over $100,000 their first year in doing it because they invested in a good year. The problem is when you're doing trading, and trading is defined as owning a short-term investment, typically 6 months or less, most of the time 3 months or less. That's trading. And it's a high frequency. You're doing a lot of them. It's creating high commissions because you're paying a commission each time you buy or sell. And those gains are taxed at higher tax rates, where if you hold investment for at least 12 months, tax at a much lower tax rate, potentially zero compared to potentially 32%, 35%. So,
Yeah, there
um,
was recently in the news. Warren Buffett had a bet with a hedge fund manager, and he invested in the S&P 500 for 10 years. And the bet was who's going to have a better return in 10 years. Was it the trader, the hedge fund trader, or was it the him who held the S&P 500 for 10 years? Well, guess what? The S&P 500 won because the hedge fund trader, with the cost, with the taxes, with going in and out of the market, even a person who is on top of the market couldn't beat the S&P 500.
yeah, and this whole thing with Bitcoins, or any kind of speculative investing, it's
Been
typically
around.
it's FOMO, fear of missing out, right?
Yeah.
Greed is a very strong motivator. And so a lot of people will make bad investments sometimes because they're just seeing everybody else making money from an investment. So they want to do the same. So they end up buying high and selling low. And this phenomenon isn't new. This goes all the way back to the Dutch tulip mania, where one bulb of a Dutch tulip was going over $1,000 at the time back then in the 1600s.
Yeah. What are they going for today? Dutch tulips? I make 50 cents.
A buck, I don't know. Yeah, I'm not a flower person. I can tell you, but a lot less
Yeah.
than $1,000.
Yeah. Yeah.
I mean, we
Yeah.
saw this, 2008, in 2000s, we had the late 90s, early 2000s tech bust. We
Oh,
had the housing crisis in '08. So just in the last 20 years, we've seen three or four different manias already.
yeah. The tech bubble, I, I met with people who were taking mortgages out on their house to invest in the .com high tech companies. I mean, it was very high speculative, and it was a good run for about 3 or 4 years. But,
Yep.
you know, after that, it dropped dramatically. Um,
The
uh,
markets are a living, breathing entity. I firmly believe this, and it's going to ebb and flow. Everything's going to get back to its normal average.
yeah,
It's like nature. It always balances itself out.
yeah. Um, you know, risk is described in the financial world as volatility, or one of the definitions of risk. And so, and as we get older, we don't like volatility. And so we want a more stable type
Correct.
of investment growth. And so traditional low cost is probably the way to go for your own portfolio. And the other thing as well is just that if you ignore your investment portfolio, you'll probably do better than looking at your statements every month, uh, because change is cost money. It does tax. There's tax ramifications, and that's kind of why we say, you know,
Buy
meet
and hold.
with free financial advisors and steady as you go. And the financial advisor is there to prevent you from getting into one of these maniac uh, trends, because people about them that they're the greatest thing since sliced bread and how
Yeah.
much money I've made.
I mean, realistically, at the end of the day, I've given you, I gave you, you asked my credentials, right? I told you master's in investment management, CFP, CPWA. I'm working on what's called my enrolled agent right now. Um, Out of all my education, I haven't listed the most important. That was my undergrad in clinical psych. Ultimately, we're in the business of helping individuals and managing personalities. And it's just helping clients helping them avoid bad decisions based on emotions or impulse, is one of the most important things that we do. If you stick to a long-term consistent investment plan, I know it sounds very vanilla and very boring. Guess what? You're going to do very well.
Yeah. Keep it simple, stupid. You know, we have a lot of other financial issues that in our lifetime. Should we buy down? Should we refinance a home? Should we lend money to our kids? Should we lend money or start? How do we come out of a business? Or how do we pick a trustee for an estate plan? Numerous financial questions that are way beyond just the investment portion of it. The investments is the apple rolling off the cart. If you've done your homework, and that
It's
homework
it,
up front is important.
well, 20 years ago, the industry focused on the investment piece. Here we are today, the focus on the financial planning, which you've already talked about a couple weeks ago
Yeah,
for that very reason.
yeah,
And Another common place that investors want to invest is in real estate, whether it's owning rental properties on your own, or there are things out there called real estate investment trusts, more commonly known as REITs, where you can put your money, it's pooled with other investors. So here you got investors, they buy the REIT, they're going to use that money and go buy, could be strip malls, could be hospitals, could be apartment buildings. They're going to collect the rent and income. Then they're going to pay most of that back out to the investors, where they're going to keep a little for running the business. And so it's a pretty common investment model. This can be a good part of someone's overall portfolio, but there are some downsides with real estate because it is very illiquid. And these products are often very difficult to understand, very costly. Most of them are going to have ongoing costs of around 3% per year or more. And if you ever want to get out of it, it can be extremely difficult to get out of them.
Some private ones. Private
Yeah.
ones are almost, I mean, they're enormously difficult to get out of.
We did a private one for our clients back in 05, and it was supposed to be a 5 to 10 year lifespan. It was supposed to be last no more than 10 years. We just unwound that last year for our clients.
Yeah. So
So
if you're going to, as you get older, you want to use the money that you have, and liquidity is a very liquidity as a factor in importance gets up to the top level when you get older. And real estate, how do you get out of real estate? Do another 1031 exchange, or how do you, and if you sell, there's an enormous capital gains tax. So you may, if you're like real estate, you may want to look at a REIT on the exchanges because liquidity is there. You can sell a REIT usually within 3 to 5 days on a publicly traded platform.
exchange, yeah.
Yeah, exchange.
Yeah, some REITs can trade like stocks, is what Peter's talking about. Those are the public ones. Those are more liquid, easier to get in and out of, for sure.
Yeah. And if you're an investor in real estate, one of the things that you may want to do is, what is your real return? Take a look at it. And with appreciation, depreciation, all your expenses, very few people run the numbers because they're so busy working that property.
Yeah, we have a huge collection of, with our Irvine office being our main office, most of our clients live in California. I do a lot of this analysis for my clients you're talking about, Peter, showing them their actual rate of return. And a lot of times in California, I would say greater than 95% of the time, the rate of return is less than just putting the money in a treasury for 5 years and letting it sit.
But people don't believe that.
Yeah, but again, it's the
It's
cost and the tax implications and everything else.
Yeah, in Orange County, I mean, property values, we've got to be in property. And until you do that analysis to see what your actual return is, and what you may want to do is that if you own real estate, what are you going to charge for your personal time that you spend on it? It doesn't just happen. Or, give yourself a rate, pay myself $75 an hour, and add that into the cost and analysis of your real return. Let's go to your next slide.
All right. So looking here at
Another
reverse
product.
mortgages. Yes, this is another product. Started gaining traction in the early 2000s. It's pretty well known today, being a reverse mortgage. For those of you that aren't aware what a reverse mortgage is, once you're stage 62 or older, if you have equity in your home, essentially the bank puts a loan on that equity, and then they turn that equity into an income stream. So these were very popular, got sold because it was making banks a lot of money. They are very complex. So just to qualify for one of these, now you have to have a call with an independent third party that is just going to gauge that if you have the cognitive function and the ability to understand the reverse mortgage. If they say you don't, you can't get one, because they're that complex and that hard to understand, and trying to make sure that seniors are not being taken advantage of.
It's and they're not, if you see it advertised on TV, it's probably not the one you want to buy. Somebody has to pay for that marketing that they do. And they're, first of all, that the product is there. Okay. It's to me, it's what's called a last resort alternative. I want to stay in
Correct.
my home. I'm 85 years old. You know, it's difficult for me to move. Hey, reverse mortgage can be a great product at the time, with the right reverse mortgage.
Correct.
But they're selling these reverse mortgages. Hey, so you could take a vacation in the Bahamas. Uh, uh, People who are
So
65 years old, and you know, these this is not a product. This is debt. You're buying debt essentially.
yeah, most commonly where I see these being used, and like Peter said, like most of the products we've talked about today, like annuities, REITs, reverse mortgages, Bitcoin, a lot of these are not things that we lead with, but they're important arsenal to have at our disposal if they make sense for the right person in the right circumstance. So these
Yeah,
are not bad products.
yeah.
They're great for
They're
the
not
right
like
person in the right
toothpaste,
circumstance.
like you need them, every
Yeah,
day.
but it's not like a stock and bond portfolio where everybody
Yeah.
should have that as a core investment. These are one-off scenarios, and it's important to understand that because they can be valuable. I had a client who all their money got spent because the husband was at home and had dementia for 15 years. That ate up literally $3.5 million of their estate. The wife was left with very little and she wanted to stay in her house. So we helped her with a reverse mortgage so that she could age in place, stay at home, live in the house that she's lived in for over 50 years, and live the same comfortable lifestyle and make sure she was protected.
Yeah, and there's a lot of traps in here too. Like say for instance, if you go to an assisted care facility, you can't rent out your home. That's part of the contract. They want you to, uh, uh, so you, in some cases, in cases I've had, we were forced to sell the home and in a bad market, and uh, uh, and because of the reverse mortgage. So these are not all positives. Thankfully, they're there as that last resort. But please have somebody like a Paul, a CPA, somebody who's familiar with these things, have them review it. Have you ever had they demand that before you buy this, that an outside person actually review it. I've never heard of an outside reviewer saying no to the reverse mortgage. Have you?
I have not yet. I did experience one where it was almost turned down.
Almost turned out, but they did.
Almost. It was
Yeah,
almost, yeah.
yeah, yeah. So I don't know how that third party review is. It's kind of crazy. Let's go to the next slide.
That's all that I have.
Okay, let's talk about some of the other products. What about just your regular mortgages? Are those a fiduciary relationship when you go and into Bank of America and you say, "Hey, I want a mortgage"?
No, they're not. There's
They're a
no
product.
fiduciary standard there. It's a product. Yeah,
So there's a sales commission there.
of
So not,
course.
and the sales commission can be different. Uh, no matter at what institution you go to. Okay. Uh, Credit cards, another
Avoid
product.
credit cards are great if you don't carry a balance and you know how to use them. I've taught several of my clients like how to use them correctly. Like I have a travel credit card I use. I use it for all my expenses, pay it off each month. Me and my family just took a 2-week trip up to Seattle for a family reunion. All expenses recovered because of our credit card use over the last year.
You can use them
So,
really wisely. At Long Beach
yeah.
State University, when I was working there, every start of every semester, there would be 5 different tables of 5 different credit card companies giving away $1,000 worth of free credit to students. Wow.
When I was 18, first day on campus, I walked into that exact trap, was given like $3,500 as an 18-year-old, um, in credit limits. Luckily, one of my best friends, his father was a financial planner, took me under the wing because he heard me talking to my buddy about it and, taught me how to handle it right. So saved me a lot of heartache and headache.
Yeah. Well, one of the things that I find is that individuals will not ask what the price of the product is, but they'll ask, what is my monthly payments going to be?
Oh, that's the old car salesman trick. You just tell what payment do you want? I'll do the math to make it last. So where you should have a new loan really shouldn't be longer than 60 months at the longest. Typically 48 months is kind of where you want to be. Oh yeah, we'll make it an 84-month loan,
Yeah.
to get you the payment you want.
Leasing and buying a car, nobody does the numbers. I mean, leasing is become so popular because of that monthly payment.
Yeah. And
And
leasing can be right for the right person in the right situation. But again, you
exactly,
got to run the numbers. Yeah. I
you
just
know, um, another product, 1031 exchanges. Who makes money
so
there?
Okay, so 1031 is a little bit more complex. That is for everybody to make sure you understand, is that's where you own a rental property and you're going to sell that and buy a new rental property. By doing a 1031, that allows you to not trigger taxes when you make that buy and sell transaction like it normally would. Now, there's a lot of parameters around it and a lot of restrictions. You got to identify the property in 180 days, blah, 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 blah. So they are very expensive to do, but the expenses on those oftentimes are lower than the taxes that you would pay by not doing the 1031.
Yeah.
So they can be very useful. In fact,
You
I
know
do
what?
those a lot. Yeah. So, like, for example, I said earlier, the average rate of return I'm seeing in California rental properties right now is under 3%. So, a lot of my clients are taking that properties going out of state, where it's more landlord friendly, lower costs, higher rates of return, into another state where they're able to do that transaction, not trigger any taxes, and get a better return on their money. So, those
You
can be
know,
very advantageous.
another product that commissions and expenses are very well hidden. It's getting a little bit more light, but that's bonds. I mean, should individuals buy individual bonds?
If you're an individual buying bonds on your own, unless you have expertise and experience, probably best to start with ETFs or mutual funds. Bonds work like real estate, right? For the real estate, you have to have a broker that's going to help you identify the property, sell the property. They're going to make a commission. Bonds trade like real estate. They don't trade on an exchange like stock does. So you have to go out. There's a trader that's going to go buy the bond for you. So you're going to be getting a bond. Let's say it's $1,000 bond. You're going to get it. You're going to overpay for it. And then if you sell it, you're going to get less than what it's worth because that markup, that difference is how the trader makes their money or the broker makes their money.
And you don't know what that markup is.
You can ask them and then you have to do the math. And if you're good at
They
math,
don't.
it's not that
I
hard,
got.
but most
I
people
had a guy.
don't. Yeah.
I had a guy swear to me that J.P. Morgan, his broker, was going to tell him what the markup was. He goes, absolutely not. You bought the yield. You know, bonds are very difficult to purchase. We'll learn a little bit more about bonds in the equity and the bonds section, but if you want to read a good book, Michael Lewis's book on liar's poker, talk about bonds. It's a uses some bond trading language, but it's very well written. But he came out of Princeton University, never had taken a business class before in his life, became a bond trader, made $2 to $3 million his first year. And then he wrote a book about it because he found it pretty amazing that he, not knowing anything, could make that much money selling bonds over the phone to people across the nation. So be very careful. I'm trying to think of another product that's commonly sold in the finance. CDs even have a built-in commission.
No, well, again, that's tied into the interest rate calculation, right? So if the interest rate in the commonplace is 5%, they may pay you 4.9 and they're going to pocket the 10 basis point difference.
Yeah, you can buy CDs on the secondary market through your broker, but you don't know, unless you understand interest rates and the time value of money and yield to maturity, you're out of your league. It's not a great idea. Although CDs are a little bit more easier to understand than some of the other products. I'm trying to think of what if I want to buy lumber? I like forest. Is there a way I can buy lumber on the stock market?
You can buy anything you want. That's not done through the stock exchange. That's done through the options exchange, where you can buy pork belly, you can buy timber, you can buy just about anything you want. Again, highly speculative, highly challenging to manage. I know I have some friends in the oil and gas industry, where these companies are producing oil, right? And they're expecting oil to be at, let's say, $4 a gallon, and then they'll buy these options to hedge to help lock in that 4% thing. The traders that are doing that, are one of them is a friend of mine. Even he's like, yeah, even the oil executives don't quite understand what's going on in the oil markets with these speculative investments.
Yeah, well,
So
that's how the last mortgage crisis that we've had. They were selling um, uh, these mortgages to people who didn't even qualify for a mortgage.
the
So,
ninja
uh,
loans,
yeah, and
no
CEOs didn't.
income, no job.
Yeah, uh, uh, be extra careful on partnerships. Oil and gas partnerships have what's called phantom income. You get a 1099 or a K1, can't remember which, but the income that's on that sheet of paper is much higher than what you actually get. And you got to built in the cost of doing your tax return into your rate of return, because they're very, very complex. Paul, great job today. I
Thank
wish
you
we
very
had an
much.
audience. Love having you. Eugene, again, thank you for being the host and really appreciate it. And then next week we'll have what's the equities and fixed income. We're actually going to get into investments and how you should and be here. We'll have Richard Huntington as taking my place for the next couple of weeks. And I will be in France, hopefully enjoying a good bottle of wine and some cheese. So you all have a good time.